Good morning. Mark Ostwald from ADM Investor Services International with a look ahead to next week's Fed FOMC meeting, which is much anticipated. Basically, we've got two lots of key event risk coming up over the next couple of weeks. First of all, that FOMC meeting, and then the week after we have the big G20 meeting, which it's hoped there'll be some negotiations between President Xi and President Trump. And obviously that's the OPEC meeting at that week. But let's address the FOMC meeting first. If we have a look at the first chart that I've got, really this is to emphasize the point about how much has already been discounted in terms of the OIS interest rate curve for US dollars. Over the past couple of, over the past month, this shows the changes. Yellow line is where we were a month ago. The green line is where we are, where we were yesterday afternoon. As one can see, pretty much the whole curve has shifted, particularly from 1 year out by 30 to 40 basis points lower. So we are not actually anticipating a rate cut next week, though there is still a 30% probability attached to it. And one can definitely say by looking at that OIS curve that the market has certainly discounted a lot in terms of what's going forward. In fact, by March of next year, we're looking at something in the region of at least 3, if not 4 rate cuts in the States. So let's move on and look at the next chart. The next two charts are basically the US 2-year yield and the US 10-year yield. I think it's interesting that in both cases, from the peak that we saw back in November to now, we have basically fallen by in the region of 110 basis points. So the market is effectively both in 2-year terms, and if we have a look at the next chart, which is the 10-year yield, the market has really done a lot of the work that the Fed for the Fed in advance of the meeting. So one could argue on that basis that why wait for July, particularly as they've got a fresh set of staff and FOMC and a new dot plot and FOMC forecasts. Why wait till the week after when really all they're going to be doing in effect is rubber stamping what's already well discounted in the market? Well, perhaps the Fed wants to try and signal a more optimistic tone on the US economy. It might also want to say, well, we shouldn't really prejudge the outcome of the G20 meeting. Perhaps there'll be something positive come out of it, even if all the signals that we've got at the moment are not particularly great on that front. So it's sort of hanging in the balance. There isn't really a lot of benefit or any downside for the Fed to go next week rather than waiting for July, other than in terms of signaling to the market that perhaps the rate cuts which are discounted for later on in the year and the beginning of next year are perhaps over-egging the mixture, as they say. Let's have a look at a couple of other things here. I think a chart which I often post up, and that's the US Goldman Sachs US Financial Conditions Index. As one can see, since the Fed started easing policy back in hiking policy back in 2015, we're in the middle of the range. Financial conditions aren't particularly tight, and they're not particularly loose either. So from that aspect, one can also basically surmise that there's not a lot of stress in the US financial system. One thing which the Fed will be looking at very closely is my final chart, and that's of MBA mortgage applications. And what one can see is that huge fall that we've seen in long-term interest rates is now starting to give a very big boost to mortgage applications. And with that, one would hope, regardless of what happens with the retail sales numbers this week, there should be a bit of boost for housing-related type spending, furniture, garden equipment, which may help to boost personal consumption as we go through the rest of the year and offer a more positive signal in terms of US domestic demand.